Hi, this is Rocky Gore. I'm the founder of CAPX. We are a digital platform that connects corporate borrowers to lenders. Today, we have Michael Kane with us. Michael is the founder and managing partner of Calteus Structured Capital. He has been in the industry for a long time, so I thought he'd be a great addition to our chat. Michael, please tell us a little bit about you and your firm.
Great. Thanks, Rocky. Appreciate it. I just might say I'm a co-founder of Calteus Structured Capital, so there are three of us, but appreciate it. So Calteus Structured Capital goes back 28 years now. First fund was $41 million. We're currently investing out of our sixth fund, which is about $400 million. And the last pretty much four funds have been about the same size, so kind of leveling out is what we're doing. My history briefly is went to school and business school at Rice University in Houston, was with GE Capital for 6 years. They moved me out from Texas to Los Angeles 35 years ago. And then the three of us co-founders got together again almost 28 years ago with that first fund. And it's been a good run since then, doing structured finance and lower middle market mezzanine debt.
So, Michael, there are a lot of other firms that are in a similar space. They do similar types of transactions. What differentiates you guys?
I think, Rocky, if you go back to our 28 years, because the first fund was so small in that $40 million range, every transaction in that fund with an average deal size, by the way, of $3.5 million, did not have a private equity group in it because there were no private equity groups that small, wanted to do deals that small. So what we got good at early on was doing the diligence, the requisite due diligence ourselves to do deals with management teams, family offices, and not need the diligence of a private equity fund. And so while private equity funds, we do about 20% of our deals with them, and we really appreciate what they offer in terms of the diligence, and they'll hire the fancy consulting firms and a Big Four accounting firm to do the QV. When we do some of our lower middle market deals, we do that work, but do a lot of it ourselves, maybe smaller accounting firms to be more efficient to do the QV, and so have gotten comfortable through the years. So even though our funds now have gotten larger, that's still the core of what we do versus a private equity focused or solely strategy.
So based on my experience at GE, we also used to work with a lot of middle market companies. And the difference between middle market or family-based companies versus PE firms is there's a lot of work that you have to do in collaboration with the management to kind of make sure what the deal is. There's a little bit more kind of in the trenches together versus PE firm, there's a package. So it requires kind of different process, different mentality, different level of patience, I guess, to kind of go through the process.
Yeah, and I'll tell you, these kind of deals are harder to find and structure. I mean, certainly from a scale standpoint, if you wanted to be a SBIC debt fund or structured capital fund like ours, and you wanted to get as big as you could, as fast as you can, you want to do PE firms because you're going to do bigger checks, and they're harder to find, the non-sponsored deals. But yeah, we dig in and really try to partner with management. And the one thing, and this is what people who as potential investors or people looking outside in say, it's a little harder for you guys because you don't have control and you don't have a control investor. And so once we do a deal, we are effectively in bed with that entrepreneur, et cetera. And so that's something we have to diligence and get comfortable with as part of our core underwriting strategy.
So what is kind of the fund size right now, the active funds? What is kind of the AUM and kind of the typical size of deals you do nowadays?
Yeah. So the current fund, and we have both an SBIC fund with its requisite government leverage, and then a non-SBIC fund. We have two of our long-term institutional investors who want to invest without the SBIC leverage and with a little more flexibility. So the pro forma IRRs are lower in that fund, but it gives them some extra flexibility. So we have both. And if you add them together, they're currently $400 million. If you add the total AUM for our six funds, I think we're about $1.8 billion over the six funds in the 28 years, but 400 being, we're about 50% invested in our fund six, so plenty of dry powder. And our deal size basically is 10 to 45 million per transaction.
So going just beyond the deal size, kind of describe kind of a good deal for you, the ideal fit where you say, okay, this is the right deal, this is the right client. How do we go about that?
Good question. So you have the size. If you look at our history, and we have all our deals on our website at caltheusstructuredcapital.com, but you have a lot of business services and a lot of asset light. You don't have a lot of big industrial deals. Part of that is we like the cash flow dynamic. We like the enterprise values, and we are, to be clear, an enterprise value cash flow lender / investor. We're not asset based at all. And again, if you look at our portfolios, you won't see a lot of assets.
Right.
You see a lot of assets that go home at night kind of businesses that we've gotten comfortable with. But we do those, and generally we morph to non-change of control deals, so growth capital, maybe a management buyout or one partner buying out another partner. So while there's a change of effective control, you might have insiders buying out outside investors. So we like doing those kind of deals where an insider is leveraging the company, putting in some of his, rolling his equity to do a transaction. We've had a lot of success with those. And then with some employee-owned companies, we've done very well with through the years. So those kind of dynamics. And again, some are, 10 to $50 million per transaction.
Got it. Now, sometimes I hear from potential borrowers that if they do not have existing relationship where they do not know the lender that they're dealing with, they are a little bit concerned, especially entrepreneurs, family-owned companies, that's because they don't have that good predictability, or at least they think they don't. How do you respond to that? That if I don't have a relationship with these guys, why they should consider you? And then, sometimes companies do get into trouble, and I'm sure every lender tries to help out. Give a couple of examples of those situations.
Right. So, well, assuming that CAPX Capital, if they were involved, they'd say good things about us. So that's how some would get involved. Rocky, because we go back 28 years with doing these deals with employees and management teams, we've got a whole stream of history of transactions, not all of which have been great. As you point out, there's bumps in all of them, and we've taken some losses through the years. Luckily, not a lot in 28 years. And we've built relationships. I've been to weddings of kids of CEOs of our companies. I've been to a few bar mitzvahs. And I think the most telling thing is in our sixth fund, we have about 40 individual investors who are predominantly managers or ex-managers of portfolio companies of ours. So we went to them early on, I think it started in Fund 4, and going to our management teams and saying, hey, with a much lower minimum than we would require from other investors, if you'd like to invest in our fund based on how we behave, both in good situations and bad, we give you the chance to do it. And through the years, we've had, if you add up funds 4, 5, and 6, the number of people invested, it's well over 100. Now, that includes some of our managers who invested more than once, but they were part of our portfolio. They invested in the fund. They liked that. They invested in another fund. And so I think that says a lot. And what we tell potential borrowers is look at our portfolio. And if you have a company that you see might be in a related industry, ask us and we'll introduce you to manager teams. Assuming some of them are gone or were so long ago, we don't know where they are. So there's some limitation to that. But we in our references, we'll give you some references, but we encourage you, if you see something in our portfolio on our website, ask us about that company and we'll introduce you to them as well. And we always introduce to a management team of a company that has not just gone straight to the moon, that's had bumps, because you pointed out in your question, Rocky, it's great whether you're an equity investor or a debt investor, whatever you are. When a company does well, it's really easy to be a good partner, right? Oh, we love going to the board meetings. By the way, that's one, if I go back to your differentiation question, a lot of lenders, even though we own equity in 80 to 90% of the companies we invest in, we almost never take a board seat, just a board observation, right? So that's just another thing that I might differentiate. But going to the board meetings is great. It's when companies bump and you have different issues. We have a company now that's not performing well, and their senior lender, and it's just an asset-based working capital line, is nervous and would like to be taken out, and it's not a good time to take them out. We've gone to them and offered a Caltheus fund guarantee. Basically, go to this fund and say, if there's a monetary default, we're going to give you direct access to our capital call line. It's to our LPs, and you're going to be able to draw down, it's a guarantee from our fund.
Wow.
Company's paying us for it, but we're to give the bank comfort because this company. So we've gone, it's a management team, et cetera, and they work their butts off. And so we're saying, we understand times are tough in their industry. Here's something we can do. And I think we're getting a lot of brownie points, as you might exist, from both the bank and the company, because wow, we're solving a problem for both of them.
And it's like a vote of confidence when the company really needs it. So
That's right. And it tells the bank that we own 20% of this company too. We're not the control. Again, we're never the control investor. And the equity investors here or individuals have done the right thing, but don't have unlimited capital. So there's a way of doing it. We don't think we're ever going to have to put this money in, but we're willing to backstop it. And so a lot of people are looking at that as a really nice thing to do. And again, as you point out, solving a problem for everyone.
So then how do you end up finding these opportunities, finding these companies that may need financing that you can provide besides getting it from CAPX?
Right. Well, again, the 28 years of finding these deals around the country, I think people know when they have this type of deal, and it's in our size. Not that we see every one of them. I think we see the vast majority west of the Rockies where we are, but we now have 2 full-time business development people, one here in LA with us, one in Boston, who's been with us. So their sole job is out networking, taking people like me along. I'm not doing, as I'm getting toward my later years and have transitioned a lot of the responsibility to different team members. But if you want me, you think I can be helpful, I'm going to go to the Texas ACG at the end of February because, I'm not from Texas, but I went to Rice University and started my career in Texas. So I still know some of the old codgers there, and they're going to take me, and I'll have my few network. But feel free to introduce me, and I'll go along, and I buy the whiskey and the beer afterwards. So I'm always popular at that type of the time of the day. So,
and then when you get the deal, let's say we send you a deal, comes to your shop, what is kind of the process it goes through and kind of the term sheet that is produced at the end of it? How reliable does it end up being because of the process?
Right. Yeah, that's a good question, Rocky. We don't issue a term sheet without doing a decent amount of diligence. And I think that's cost us, if you go back and occasionally that has cost us some deals.
Yeah.
Because we take a little longer before the term sheet. So we do diligence. We want to talk to the banker, if possible, talk to management beforehand. We meet every Monday as a group, Monday morning at 9:30. And we don't issue a term sheet until we've got enough information to go to a 2-page, we call it a 2-page or a teaser, that we go to the group with that's got the core of how we're going to underwrite the deal. And what I mean by that is we haven't done all the work. We've done none of the real hard diligence, but says, here's what's been represented. Here's what we as the deal team think is the right deal. Here's the pricing, the debt versus the equity. Here's how much senior debt will allow on top of us. We do that in this teaser and say, based on the information we know today, and that information is more than usually just a book or a thing, we dig in. If the group is okay with that, here's the proposal we'd like to issue. So the entire team has seen this deal and approved the structure, the pricing, the terms before we issue a proposal. So in our history, I can say we have never not performed on a proposal where the company has delivered what was represented. There are deals that have changed. There are deals we have walked from in diligence. There was one situation where the CEO of the company, we did the background check and didn't disclose in his history, it was 15 years ago, a felony conviction. Now, it was for something unrelated and had a reasonable explanation. But in our questionnaire, we said, have you ever done the felony? No. Okay, we did the background check. Yep. Oh, yeah, I didn't. Nope. No, we're out. And so, and by the way, had he disclosed it, we would have been in. It wasn't big enough. But anyway, that's a silly example, but there have been things, and in business where we've done a Q of E, and like the EBITDA you said was 7, looks more like 5.5. We might be willing to do the deal, but the debt is less, and that kind of thing. But with those proposals, we make sure we have buy-in. And again, that I think in sometimes our history is like, well, we got a proposal from another group, we got it a week ago. It's like, yeah, okay.
Yep.
We're not willing to do that.
So based on what you just said, that you do due diligence and sometimes the data that comes out that is quite different than what was presented to you. We've been seeing quite a bit of that nowadays, or at least in the last 18 months because of the economic uncertainty and the uncertainty of the deal environment. What are you seeing in the market in terms of the types of deals you are seeing, more M&A versus refinancing versus sponsored, non-sponsored? What are the trends?
I don't know about trends, Rocky, but I think it's definitely gotten, and you know this from your seat more than anybody, is it's gotten harder to close deals. It takes longer. I think
Yeah.
people are doing more work. You had what COVID brought. Now you have the whole diligence as to certain companies benefited from COVID and certain got crushed. So the ones you have to understand, have they've come out? Is that a real? Is there some blip they got a positive from COVID and that's not going to keep? And so people are underwriting to that. You want to go real time today, with tariffs and government spending.
Yeah.
How do you underwrite that right now? That there's going to be tariffs on Mexican agricultural products and Canadian timber products and Chinese tchotchkes, for lack of a, how do you underwrite that? And you can put templates on them, but there's a big beta between how it is today and how it could be in a worst case scenario, and where do you do that? So I think for certain businesses it's going to make things a bit tougher, but that's what groups like ours I think get paid to do, is find those deals, underwrite them, and maybe if there's a certain company that has some risk to a tariff, you'd like the business, but maybe a little less capital up front. Let's see how it plays out, kind of situation.
So then when a company, a CEO or CFO wants to come in front of you guys and pitch you what they are looking for, what would be the tips? I mean, what should they be telling you? What is kind of the right information to give you?
I'm going to look at this question, Rocky, as kind of a first call. If a CFO calls us and maybe doesn't have a banker that package the information. So a CFO direct call. One, a little, what do you need money for and how much? Is it an acquisition? Owners, want a dividend. The owners are getting up in age and want to diversify their net worth beyond just stock and a successful private company. Does one owner want to buy out a passive owner, maybe management? So what's the use of proceeds?
Right.
How's the business been going? What excites you about the business going forward in terms of whether it's an acquisition or things, or why do you as a CFO and the CEO want to buy out these partners? What's exciting? And then what are the risks? What do you see as the risks in your business plan? And that's the first call, because that could get me excited for a deal. And I'm obviously explaining some of the things we've talked about of what we can help with you in terms of making. The one thing we do, Rocky, with a lot of these companies that aren't with PE is we work with them on giving us reporting that a PE firm would appreciate. So when they're ready to do something maybe grander or
they're ready for it.
We've given some institutional knowledge on reporting, et cetera, but that type of thing. So that first call, and then we can all think, does it make sense to have a follow-up call, and we can give a more detailed diligence list. So I look at that first call as just trying to get to know someone, what the deal is, why you want to do it, and what are the good and the things about your business and the risks. And me then pitching them on how I might be helpful and
sure. So I think just to kind of tell you a little bit about, I mean, you experienced this, but the way our process works, the teaser that comes to you basically captures this information that you're looking for. That's how it's designed.
Yep.
The CFO or CEO puts in the information, or we help them do that. And ultimately, what it produces is this first call information that you're looking for that kickstarts your process, and you can go from there.
We found that with CAPX, and it makes it easier to, really decide if it's something we want to spend more time on. I know, Rocky, a few of the things we've looked at through the years have been more senior debt focused, so just not a perfect fit, and the markets have been good, and so some other things that we have spent more time on, but it does make it easier having someone like CAPX in the middle, kind of ferreting through some of that inside information, not inside information, some of the information coming from the insider, putting it in a nice form.
Sure. And then, a lot of times your typical middle market borrowers are not exposed to fund like yours or lenders like yours. They are more used to banks, and they might have some different ideas about what these credit funds are, what would you tell them? What kind of main distinction, you guys versus classic banks?
Banks. Well, I mean, the first thing they usually see is, wow, you're a lot more expensive than my bank.
Sure.
Which is that, and that we're used to. But, a couple of things. One, the flexibility that we afford generally in the amount of capital, the looser covenants, the lack of amortization. We have no amortization in our deals for 5 years. So they're all interest only. We never require, and we haven't, a personal guarantee, which many commercial banks require, even as companies get larger. We like working with commercial banks. The SBIC fund we have has 30 commercial bank, 25, I think 25 bank investors in our SBIC. And we spend time trying to work with them to say, hey, you've got a client. We don't want the working capital line. We don't want the cash, all the things they love, the fee generating, the cash management. Yeah. We're not taking any of that. We'll be supportive. We're just going to take some of the credit risk off your plate. So we try to use banks as an ally. But again, back with a CFO who maybe just has a bank and been a long-term trusting partner of theirs, we just say we want to work with your bank and help them. And yes, it's more expensive. We try to do it where we compare it to equity, where if we lend you money at X %,
yeah,
but it's permanent capital because we don't want our money back for 5 years or 6 years. How much your company would you be selling if you raise that money versus? So
sure.
That oftentimes is not successful, but at least it gets them an appropriate balance between what a bank can do and what we can do.
And then last, Michael, if somebody was starting their process to raise capital, what kind of one recommendation or advice you'd give to them? That's kind of probably applies to all the lenders, but they need to have that.
It's you got to have a good understanding of the information and just be honest with everything, good and the bad, and really understand the business. It's the thing sometimes we find with some of our entrepreneurs or the CFOs, the entrepreneurs will certainly understand the business, but maybe don't have a good handle on what's important to an outside investor / lender, and hopefully a good CFO, but really knowing where the business is, not just the numbers, but where the business is relative to the environment, et cetera. Very important. And we can usually see how good, easy or hard it's going to be to get comfortable with that within a call or two. And again, I would, without being too much of a plug for CAPX, because I like you and everything, but that's where something like you will see it going through your process with a borrower. You can't get good information out of them at your level. I'm guessing you're going to call timeout and say, we need to do some work before we get, whether it's the Caltius or your other potential investors, because you're going to have a tough process if you don't have that lined up. So
yeah, I mean, our whole goal is to get them the capital they need as quickly as they can. So at some point it ends up becoming, what is the quality of data going in? So if it is not right, we tell them that they have to add this additional things. We help them with that. So when it comes to you, we have the information you're looking for.
Exactly. Very important.
Well, thanks a lot, Michael. This was great, quite helpful. I'm sure some other people will find it helpful as well.
I hope so. Thank you, Rocky. Appreciate the time.